Hello and welcome to my take on your Daily 5 for the 6th of August. My name is Julius de Kempenaer, presenting to you from Amsterdam in the Netherlands, and it is my turn again to host the show today. I'm a senior analyst here at StockCharts.com and the creator of relative rotation graphs. These are the swirly charts in which we can visualize the rotational character of markets. They're often referred to as RRGs. You can find my contributions in the RRG blog on the site, as well as on StockCharts TV, where I host Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. If anything related to sector rotation and relative strength has your interest, please check out these resources, or even better, subscribe to them so you will get notified when new articles and episodes have been uploaded. I enjoy the interaction with viewers and readers, so if there is anything you want to share, please make use of the comment sections below articles and videos, or simply drop me a message via email. Today's charts for the show are coming from the Dow Jones Industrials universe, and you'll see the RRG for this universe on the left-hand side. I've quickly plotted the chart of the Dow itself on the right-hand side. It's a weekly chart, and you can still see that overhead resistance that's in play around 35, 200, maybe slightly higher. And as long as that resistance is there, I think there is still risk inside the Dow and the markets in general, especially as long as this negative divergence between the price of the index and the RSI is not negated or taken out or ended. Nevertheless, it doesn't mean that there are no interesting charts inside this universe. As people know, maybe if you heard me before, you know that I find it maybe equally important, maybe even more important, to focus on where you should not invest rather than focusing on where you should invest or looking for buying opportunities. Very often, just by avoiding big bleeders in an index, you can actually outperform that index as long as you avoid those big bleeders. So the first thing that I'm going to do is I'm going to point out a few stocks which I think you should better avoid. By the way, if you look at the RRG here, then you can see that the universe is very evenly spread out. However, there are a few very nice tails pointing into the leading quadrant, but also pointing into the lagging quadrant. Now, if we start with the lagging quadrant, there's obviously quite a few of those tails. There is no time to go over all of them. And the ones that I picked out, the first one is Dow. It's not the Dow itself, but it's the company Dow Holdings. Now, if you look at that tail, that is pointing straight into the lagging quadrant. And it is actually just crossed over like 2 weeks ago. If we bring up the price chart for this stock, for Dow Holdings, you can see that after that spin-off, it's limited history, but still 2-3 years. What I'm looking at here is that very strong uptrend that was broken not too long ago. So we got a break of that rising trend line. We got a pattern here that maybe if we got a little bit more upside in coming weeks and then go down, that could work out as a head and shoulders reversal. A bit early to tell, but I'm keeping it in mind. But what's more important for me, especially from a relative point of view, is that very clear break in relative strength and the RRG lines pointing lower, and that is pushing Dow into the lagging quadrant, making it one of the stocks that are definitely better avoided. The other one is a financial stock, it's JP Morgan. If you look at the tail, it looks very much like the tail of Dow, pointing rapidly into the lagging quadrant. And if we bring up the chart for JP Morgan, then we can see like most part of this year, a pattern that definitely starts to look like a head and shoulders reversal, could become one. 145 is the level to watch. And we see something that looks like a double top in the making in the relative strength line, and it's pushing the RRG lines lower versus the Dow Jones Industrial. So that makes JP Morgan also a stock that's probably better avoided. Now, if we go to the good stuff, then the first tail that really stands out, obviously, is Apple. Big name, big stock, very important stock. If we look at the price chart, then for sure it is, from a price perspective, a very good looking chart. Massive ascending triangle. We broke out of that triangle, out of that consolidation a couple of weeks ago. We're holding up above that former resistance level that's now support. And based on the height of the pattern, that's 105 to, let's say, 135. That's easy, so $30. You could be looking for 165 at least as a target for Apple. The one thing that needs to happen is that relative strength needs to break out of that range. The RRG lines are already anticipating that. They're pushing the stock into the leading quadrant. But what we really would like to see is a break above its previous highs, above the 2020 highs in relative strength. And then Apple will be a truly leading stock inside the Dow Jones Industrials again. Now, the second one is also tech stock. That's Microsoft. If we look at the tail of Microsoft, then you see that it is positioned well inside the leading quadrant, picking up on both scales. So that makes it a very interesting stock from a relative perspective. And if we look at the price chart, then we see that here the trend line is slightly angling down, and we've taken that out. That's a good thing. The RRG lines are now going to, well, 12-month highs probably. No, not really. 9-month highs. But it's good. They're rising, and they're quite rapidly rising, which is a good thing. But what I really like is the fact that we're breaking out of this short-term rising channel on the upside. And very, very often that means an acceleration in the rally. And that makes Microsoft a stock to definitely keep on your radar. And then finally, the last one is Cisco. It's a short tail, but it's a tail that's actually rotating back towards the leading quadrant. So we had the first run for Cisco where we moved through weakening, and we're now curling back into the leading quadrant. And if we look at the price chart for Cisco, then we see that it is actually just breaking to new highs. It's taking out the 2019 highs, one of the last stocks probably, but the fact that it's doing that now makes that 54 area a very solid support level, and there is plenty of upside. So from a price perspective, Cisco is definitely an interesting stock because it's got a very good risk reward ratio. You got a lot of upside potential, and your downside risk for the time being is limited to the old resistance, now support around 54. What am I waiting for? A break above that resistance in relative strength, and then both RRG lines starting to pick up and push higher again and push Cisco deeper into the leading quadrant. And that concludes your Daily 5 for today. I hope you enjoyed the show. Thank you for watching, and I'm looking forward to seeing you again at a future episode of your Daily 5.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.